You can get the valuations right, the timing right, the macro analysis right, the top down, the bottom up right, but the execution is supremely important. Our modelling also implies that when we do see rate cuts, they're going to be much shallower than markets expect.
Hello everyone and welcome back to a new episode of Conversations with Leaders. My name is Josh Gilbert, a market analyst here at eToro, and it's my pleasure to be your host for today. Before we start, remember to like, comment and subscribe to our channel to stay up to date with all the latest from Conversations with Leaders. Today we're joined by Christopher Joye, Chief Investments Officer at Coolabah Capital. Christopher founded Coolabah back in 2011, and today the fund now manages over $10 billion. Christopher previously worked for Goldman Sachs and the Reserve Bank of Australia, and is now renowned as one of Australia's leading economists and fund managers. In this episode with Chris today, we're going to delve into what it takes to managing a $10 billion fund and the future of interest rates and their impact on equities here in Australia and overseas. Chris, thank you for joining us today. How are you doing, first and foremost?
Yeah, I'm great. Thanks, Josh. Appreciate the opportunity to engage with the very large eToro audience.
Well, thanks for joining. It's been a busy night. We had the budget, firstly, in Australia overnight. Anything that sort of really stood out to you from that, just to sort of kick us off, Chris?
Yeah, I think if you look at the consensus economist reactions, the likes of CBA, Barrenjoey, HSBC, they all said the same thing. The budget at the margin injects quite a bit of stimulus into the economy. It will actively support growth. It does push down inflation this year, but it pushes inflation back up by exactly the same amount next year. And the budget will actually probably overall be inflationary because you've got more government spending. So the budget is at the margin, in the view of the street, going to make the RBA's task a little tougher, probably harder to cut interest rates, as CBA noted, and it means that we likely deal with the spectre of a higher for longer rates regime.
That's probably not what, as we say, we wanted to sort of hear after, that budget announcement. Again, there was a lot of conversation going into it, whether it would be, deflationary or sort of inflationary in that sense. And I think we touched on it there. But we'll dive into sort of rates a little bit more in just a moment. And I want to firstly start, though, with your career. As I mentioned at the top of the episode, you're the CIO at a fund that now manages over $10 billion. We have millions of investors on our platform, budding investors, if you like. We also have a lot of popular investors who manage funds on the eToro platform. And I wanted to get from you the best piece of advice that you can give to sort of investors when it comes to managing money.
I don't think there's one singular piece of advice. I think key principles that I've focused on have been, firstly, focusing on exploiting inefficient markets. So I think equities are very efficient. Many listed markets are efficient. We trade over-the-counter bonds that are unlisted, and they're very inefficient, which means we find pricing errors all the time. So you really want to compete where you have edge, a competitive advantage, and you want to find dark, opaque markets that are poorly priced, that are rich with alpha-generating opportunities. So that would be, I guess, one piece of advice. A second observation would be to really obviously focus on things that you're passionate about and where you have a natural wheelhouse or competitive advantage. And then I guess another thought is really focusing on the unconventional. The less trodden path, trying to be counter-cyclical and contrarian. It's not very easy because, as I mentioned, generally it's hard to beat the wisdom of crowds. It's hard to beat the market because there's so much information in the market. But markets do price assets incorrectly on occasion, and there are opportunities. But we like to focus on those inefficient markets that are less heavily competed and contested, where we can pull a lot of alpha out.
Absolutely. And I like what you said there in terms of obviously that contrarian side of investing. Again, it's not an easy task to maybe be a value investor or find contrarian opportunities, but that can be where like you say, opportunities do lie. Chris, over your course of your career, I'm sure you've had to make a lot of big decisions, and this is a question that we ask to a lot of people, is that along the way there's probably been a few mistakes, and I wanted to ask you if you had one sort of investing mistake that sort of stands out for you, and maybe how you've learned from that to sort of be where you are today and sort of be in a position to be the CIO and running a fund of the size you do.
Yeah, one that springs to mind is in late 2021, we were of the view that equities would fall about 30%, or at least 30%, that house prices would fall at least 15%, that credit spreads, or the extra interest rate margin that a bank bond or corporate bond pays you, we thought they'd blow wider by about 100 to 150 basis points. We thought crypto would get crushed. And we thought that long-term interest rates would rise much more than markets expected. And pretty much all those things came to pass. And the S&P 500 fell 26%. NASDAQ fell 36%. This is all peak to trough from December 21 to circa mid-22. Yeah, crypto fell 80%. Aussie house prices peak to trough fell 10%. Slightly less than we expected. Fixed rate bonds were hammered because interest rates rose and credit spreads went 100 and 150 basis points wider. In fact, I remember my chief macro strategist presenting modeling at one of our weekly meetings in December 21, basically showing that the US Federal Reserve needed to lift its cash rate. At the time, it was between 0 and 0.25%, all the way to 5 to 6%. Right now, they sit at 5.25 to 5.5%. And the RBA needed to lift its cash rate to 4 to 5%, and obviously they're at 4.35 right now. So we sold all of our credit, basically our bank bonds and corporate bonds, billions and billions. And we actually went short credit, which was the right trade. We made a ton of money on our shorts. And we hid in interest rate hedged government bonds, but the hedges didn't work as we expected. Because the RBA dropped its yield curve target in November 2021 suddenly, which was a huge shock to the market. It just failed to defend the target intra-month. But by dropping the target suddenly, it blew up interest rate markets, and that had knock-on consequences for our hedges. The government bonds we bought performed really well if we'd hedged them with interest rate swaps, but we hedged them with interest rate futures. Had we had our time again, we would hedge them with swaps. And so the asset allocation and macro analysis was bang on, but the hedges weren't ideal. And the lesson there is really focusing on the precision of our hedges, which is a mistake we won't make again. But it would have made enormous differences for returns between December 21 and June 22. In mid 22, we were of the view that our markets had appropriately repriced. And we sold all our government bonds, and we went back into bank bonds and corporate bonds. We bought about 10 billion of them, and have had spectacular returns since in the last 12 months. After retail fees, our A+ rated floating rate bond funds have returned about 12.2%, and since that time they would have returned 20 to 30%. So yeah, it's interesting. You can get a lot of things right. You can get the valuations right, the timing right, the macro analysis right, the top down, the bottom up right, but the execution is supremely important. And it's not just about buying or getting long or getting short. That execution, I think we did brilliantly. Where we could have done better was the hedges, which are kind of normally fairly run-of-the-mill. Like the hedges are just a kind of standard part of our process. But we've learned over time that there's actually a lot of intellectual property in getting the hedges right. I think for equity investors, there's not really a direct analogy, because equity investors, unless they're going long and short, don't normally hedge. So you're normally in the market or out of the market. But it would be like running a long-short equity portfolio and wanting to hedge the equity beta and not getting the equity hedges as precisely calibrated as you might otherwise want.
Yeah. And like you say, I think even if you sort of have the sort of the perfect scenario, which it sounded like you did there, like you say, that execution has got to be sort of spot on. And I think that's a good lesson to know that even if you may have everything right, things can still sometimes go wrong. So I think, investors, that's something to note, to not be too hard on yourself in the future. Chris, you mentioned a little bit about macro there, and obviously, as you say, your sort of team and yourself called the macro environment in the US and Australia pretty bang on. So we'll start overseas and we'll go to the US. And as we're recording this, we're actually going to have US inflation released tonight. So I wanted to ask where you sort of see US inflation going over the next sort of 12 months. And then following on from that, how many cuts you think we're going to get from Jerome Powell this year, if any at all, given that at the start of the year, markets were pricing in sort of 4 to 5. And obviously, as we know, that has now significantly changed.
So, I have 47 executives that work for me in my team across London, Sydney, Melbourne, and Auckland. And that team comprises 11 traders and portfolio managers and 18 analysts. And most of those guys are quants. And we use up to 80 different mathematical models to price bonds around the world. Typically, we trade about $700 million of bonds a day. Over the last 4+ months, so since the start of January, we've traded over 50 billion of cash bonds. And we're one of the most active traders of bonds globally. And we're just hunting for these little mispricings. The macro isn't important to us day to day necessarily. And we don't trade macro on a high frequency basis. So what we're focused on is these granular bond mispricings. Our hit rates are around 80-90% in most markets. So the models are very accurate. It's a very consistent alpha generation and return driving process. Episodically or infrequently, macro becomes supremely important. So some investors will say, I'm a stock picker, I don't worry about macro. You often hear that from equity guys. Like, I'm a small caps guy, I don't care about macro. I just pick stocks. We think you should care about everything, and we try and model everything. So notwithstanding that, we might have 80 bond pricing models, but we actually do an enormous amount of quantitative macro forecasting and modeling. So we're forecasting, Aussie inflation rates, US inflation rates, European inflation rates. We're running, many, like too many to count, macro models around the world, trying to anticipate the future, which is important because what we do find, Josh, is that infrequently macro becomes of profound significance for asset pricing. So every so often, the market will throw the baby out with the bathwater, and that day-to-day trading process where we're doing 700 million of cash bond trades a day, looking for little mispricings and grinding out those mispricings and getting it right 80 to 90% of the time, that process can be perturbed by big external shocks. And we've seen those in 2008, in the GFC, in 2011-12 with Brexit, the first Eurozone sovereign crisis, in 2015-16 with the second Eurozone sovereign crisis and the near collapse of Deutsche Bank in February 16. If we go back in time, the taper tantrum in June 2013, when the Fed first started to normalize rates in 2018 with the Fed cash rate going to 2.25%. We had a 20% drawdown in equities and credit spreads moved wider. Then with the pandemic in March 2020, and now the huge interest rate and inflation shock over 21, 22, 3, and 4. So we think macro is super important, but we don't trade it off every day. And just to provide more nuance there, we actually think trying to second guess where interest rates are going tomorrow, next week, next month, you're on a hiding to nothing, because like equities, the interest rate derivative markets are exchange traded, super efficient. There's actually a lot of inside information in those markets. Very hard to get edge. Bruce Kovner, the founder of Caxton Associates, one of the first macro hedge fund traders ever, used to say that you always follow the Russian money in FX markets, as an example. And you might say, why would you follow the Russian flows in currency markets? Because the KGB, the predecessor to, as you would know, the SVR, which is today's contemporary Russian foreign intelligence gathering agency, the KGB used to have a listening post in Cuba that was directed solely to picking up Wall Street intelligence. Make no mistake, the Chinese, North Koreans, Russians, Iranians are trying to hack the Fed, the RBA, all the statistical agencies like the ABS and the BLS in the US, they're trying to trade this stuff to get edge themselves illicitly. So there's actually a tremendous amount of public and non-public information in equities, FX, rates, and it's very hard to get edge. It's why macro traders actually tend not to do well. But we do think that on a low frequency, every so often basis, you can pick really big dislocations in markets, which is what we did in 2021, and frankly what we did in June 2022, and what we did at the start of this year. At the start of this year, the bond market was pricing 175 basis points of cuts from the Fed. We said that that was just demonstrably wrong. I write a weekly column for the Australian Financial Review. Every single column this year, I said, watch US services inflation, watch US wage growth, and that will be the tail that will wag the global asset pricing dog, because all roads lead back to services inflation, which we felt would force a re-acceleration in US inflation, which is what we've seen over the last few months. So you're right, we've got US CPI coming out imminently. It's crucial. We've had 4 consecutive upside surprises for the market, not for us, for US CPI. There are 2 key US inflation measures in the US, the CPI and then something called the core PCE, which the Fed focuses on. And we've had 3 consecutive upside surprises for core PCE. Last night we had the producer price index, which is an input into or a series that you can use to forecast CPI and PCE, and that was an upside surprise as well. So our core thesis this year, without getting hung up on picking 1 month's data print, statistically our analysts are saying, listen, we've had so many upside surprises. If you just look at the volatility and the inflation, it frankly wouldn't surprise if we had a softer number month to month, just on a noise or pure volatility basis. But our central case is that US inflation will remain much stickier than the Fed expects, which will keep the Fed on the sidelines, rates higher for longer, and that is true both in the US and globally. All year we've been arguing that there's going to be a problem with global services inflation, which is being driven by global wage growth, which is in turn being fueled by excessively tight, artificially tight global labor markets. So unemployment rates are too low. And we're seeing a globally synchronized upswing in service inflation, which is running at circa 5 to 7% in the US, UK, Europe, Australia, and New Zealand, where all those labor markets are close to historical tights in terms of the jobless rate. And we're seeing a combination of strong wage growth with weak labor productivity. So what that means is productivity adjusted wage growth, which is what central banks really focus on, is really strong in most countries around the world. And what we believe is the Fed made a catastrophic error late last year with its so-called dovish pivot. And it made the same mistake it made in 2021. So in 2021, we argued there's a demand side problem. Basically, governments are spending too much money. They're artificially inflating the demand in the economy through zero interest rates, but also huge budget deficits. We saw this last night with our government. Our government has put in tens of billions of dollars of extra discretionary spend into the economy at the same time that the RBA is trying to slow growth to bring inflation back to earth. In 2021, the central banks of the world said that the increased inflationary was going to be transitory because they'd shut down supply chains, good prices had gone up, and they argued that good prices would come down. We agreed with that part of the argument, but we disagreed that would pull inflation down because we thought we had a demand side problem in 2021 that would continue, and we argued it would be a multi-year battle to bring inflation back to the central bank's 2 or 2.5% targets. We sit here in 2024, we still have an inflation crisis, and it doesn't look like it's going away. In late 23 last year, the Fed, as those goods prices were coming down, it got head faked again, and it basically said, whoop-de-doo, we've broken the back of this inflation crisis, we've won the war, the next move in rates is going to be down. And that's why you had a tremendous surge in equities, and you had a huge reduction in interest rates or discount rates or long-term government bond yields. So the US 10-year government bond yield in October last year was at 5%. By January this year, it had fallen all the way down to 3.8%. Now, since we've seen this run of strong services inflation data, which has been pushing up overall core inflation, in the US, just to give you the numbers, on the CPI measure, core inflation has bounced from 3% to 4.5%. On the PCE measure, it's gone from about 2% to 4%. Since that time, discount rates have popped back up. So the US 10-year government bond yield has gone from 3.8% to about 4.5%. But equities really haven't reacted. Equities are still about 20 to 25% above where they were in October last year, preceding the Fed's dovish pivot when the 10-year yield, the 10-year US government bond yield was at 5%. So we think there's a lot of hopium in risk markets, whether it's AI related or hopium that the central banks will be able to crush these inflation problems. And to be honest, this is being stoked by, in turn, excessively dovish central banks, which we think are politically compromised, where the Fed isn't reacting to the data as it normally would. A US bank bond trader recently wrote on Bloomberg that if this wasn't an election year in the US, there wasn't a presidential election on the 5th of November, we'd still be in a hiking cycle for the Fed. And the RBA has been incredibly dovish, notwithstanding big inflation problems here in Australia. We think because they don't want to offend the government, because they're still negotiating the new monetary policy setting process. There's going to be 2 new RBA boards that have got to be negotiated with Parliament, and those negotiations have yet to be concluded. So the RBA is doing everything possible to basically blow wind up the arse of the government and not offend them. So we think that there are real risks, downside risks in asset prices that are not properly pricing the probability that we have a protracted, elongated inflation problem that will force discount rates to remain much higher than they have in the past. In terms of the CPI data in the next 24 hours, all things being equal, we're looking for a strong number, with the caveat that we've had 4 strong numbers, and statistically, it wouldn't surprise if we saw a bit of noise to the downside.
Yeah, a very political driven year, as you sort of mentioned there, Chris, as well. And it sort of leaves a very interesting landscape. And I want to sort of go to equity specifically there. And again, I know you do a lot with sort of bonds, and we can touch on that as well. And as you sort of say, we've seen multiple record highs this year. We've seen, pretty decent earnings growth in the US as well, coming off just sort of the most recent earnings season. Obviously still being led by Magnificent Seven. Obviously, as you mentioned, AI been a huge driver for stocks as well, probably one of the reasons we are where we are. So diving in specifically to equities, given what you just sort of mentioned, that macro landscape, what do you think is next? You sort of mentioned maybe we see a bit of downside. Is that your view over the next 6 to 12 months for equities?
Yeah, Josh, we think there's a lot of downside risk in equity valuations, and I'm sharing right now some analysis we've done on this. So here on the top left-hand corner, we have the cyclically adjusted price earnings multiple, known as a Shiller PE or a CAPE PE, for the S&P 500 going back to 1880. So hundreds of years. And basically we're at 34 times right now. And normally this sits at about 16 to 17 times. And there's only 2 other times in history where equities have looked more overvalued. Just prior to the tech wreck, where they fell 50, 60%, and prior to the GFC, where they fell 60%. So on that basis, obviously there's a Magnificent Seven story there, but equities look very rich. We also run the Fed's model of something called the equity risk premium, which is basically the extra total return you get from US shares above US 10-year government bonds. Normally you get about 4.8% in additional return from equities. Right now it's 2.8%. And that's extremely low, obviously, by historical standards. And that suggests that forward returns from equities could be challenged. Here in Australia, we like to look at a similar model. And this compares basically the interest rate you get on major bank bonds with the total return on major bank stocks. So here we have in this middle chart 1 year forward earnings yields for the 4 major banks less their bond yields. And normally big 4 major bank stocks are giving you an earnings yield that is 6.4% above their bonds. Right now it's back at 4%. And relative to history, Aussie bank shares look about 40% overvalued relative to their bonds, as you can see in this chart here. So I think obviously there's many things that can potentially come to pass, but if government bond yields remain structurally very elevated. We're likely to see much more stress in the economy. Unemployment rates need to increase to reduce wage growth, to in turn reduce services inflation. And that's likely to put pressure on many marginal businesses that can't survive in a world where they don't have access to perpetually cheap money. And what's interesting is in the US, bankruptcies last year amongst companies covered by Standard & Poor's were basically the second highest since 2010. And in Australia, if we look at insolvencies, they are currently the highest in 25 years of data. This is ASIC data we're looking at now, looking at monthly insolvencies. Yet the overall economy is fine. The Aussie economy is okay. Unemployment's incredibly low. Wage growth is very strong. Similarly, in the US, GDP growth has been super strong. Unemployment has had a 3 handle in front of it, near post-World War II lows. So the economy in aggregate is doing really, really well. But what we're finding is that at the margins of the economy, there's a lot of vulnerability. So zombie companies and riskier borrowers who are not representative of the average borrower, but nonetheless are vulnerable, are starting to experience pain. This chart looks at the default rate on Aussie home loans issued by banks, which is the green line, and non-bank lenders that are not regulated, which is the blue line. And we are seeing a big increase in delinquencies amongst non-bank lenders, borrowers. And this is true also if we look at their prime loans, their best borrowers, banks versus non-banks. Bank arrears on their home loans or bank defaults that they're seeing on their home loan books have increased modestly, whereas we're seeing a massive spike in non-bank defaults. So I think that this is very important from an investment perspective because it suggests you want to avoid cyclically sensitive sectors that are likely to perform poorly in an environment where inflation is persistent and central banks are likely to have to deliver hard landings in order to break the back of that inflation pressure. Just on that note, many listeners will have heard the prevailing intellectual narrative over the last 6 to 12 months has been this idea that we've had a soft landing. But I don't like to be the bearer of bad news, but there has been no landing at all. Inflation is not at 2%. Inflation is running multiples central bank targets. And so therefore, ipso facto, there has been no landing. And the only landing that we can see right now is a hard one, unless we get some miraculous, productivity panacea. So if, artificial intelligence does deliver a productivity miracle, perhaps that can be the in turn inflation solution or panacea, but we don't see that happening in the foreseeable future. And so we think the key message should be for investors, this cycle is not over, and this cycle is likely to be highly elongated, and you're going to see cumulatively more and more distress and pain. Bonza Airlines collapsing the other day is one example. Aussie insolvencies at 25-year highs, notwithstanding the ostensible economy overall is doing fine, is another.
So, Chris, given all of that, then, if we sort of put all that together and we talk about, as you said, a little bit earlier about sort of the Reserve Bank sort of, taking a bit more of a dovish tone so far, sort of really this year, really over the last, 5 months to start this year, we've obviously had this conversation that rates, maybe need to go higher again in Australia. And I think you've been someone who's said that maybe rates aren't restrictive enough. And we've seen, again, a lot of commentary around that. Do you think the RBA need to hike again? Do you think we need to see rates be higher? Or do you think we will just see rates stay higher for longer in Australia?
Well, the RBA is in a very, very historically unusual position. So don't listen to me. Look at the RBA's own macro model. It publishes its macro model of the Australian economy. It's called the Martin model, and that implies that the RBA's cash rate shouldn't be at 4.35%, it should be at 5%. If you look at our key peers, New Zealand's at 5.5%, Britain's at 5.25%, America's at 5.25% to 5.5%, Canada's at 5%. If you look at productivity adjusted wage growth in Australia, it's running at around 6.5%. It needs to be at 3% for the RBA to hit its inflation target. and that's because unemployment is too low, growth is too strong, and then now we're pouring massive fiscal stimulus on the economy at precisely the wrong point. And you're seeing that all around the world. It's not just the federal government. All the states are spending a lot of money and generally running large deficits. Overseas, there are huge deficits. Biden has led the way. He's running a budget deficit of 6 to 8% of GDP, aside from the GFC and the pandemic, unheard of in the post-World War II period. So you have fiscal policy pumping up the economy at exactly the same time that monetary policy is trying to deflate it. So policy is working in conflict. And I think that's highly problematic. And then you have to ask yourself the question, well, why? If the RBA's models are saying they should be at 5%, if inflation's re-accelerated, if the central banks consistently got the inflation story wrong, they got it wrong in 2021, they got it wrong in 23, they got it wrong in 24, why are they doing more? And, the counterfactual is, or the shadow that lurks over this debate is obviously politics. The IMF has recently come out and warned that with half the world's population voting for leaders this year, there are heightened risks of political interference in central bank decision making. With the government's budget, we've seen this really weird situation where they're giving every Australian family $300 for their power bills. It's not means tested. And that's from a Labor government that would normally means test this stuff. Why? Because by giving households $300, they will artificially reduce the official inflation data by about 0.7% this year. But it's really weird and a massive waste of money because as soon as that subsidy ends next year, the inflation data goes back up by 0.7%. So they are literally spending billions just to sandbag the inflation data this year prior to an election. It's not exactly kind of rational or responsible economic management. And it's kind of assuming that we're all myopic and just look at that data. And it also assumes that, assumes the RBA looks at just the inflation data this year and doesn't think about the fact that it washes out next year, which makes no sense. But the RBA has been very, very dovish. It does look like it's being influenced by the political dynamics, which is understandable because they're trying to negotiate a new monetary policy framework with the government. But it is sobering to note that normally over the last 30 years, Aussie interest rates, or particularly the RBA cash rate, has on average been 150 basis points above the US cash rate, or the Fed funds rate as it's known. And at this point, we're almost 150 basis points below that rate. Or a solid 100 basis points below that rate. It's clearly the case that interest rates in Australia should be higher. They should be at 5%. Whether they get there or not, that's a matter for the political economic dynamics to play out. I think the second quarter inflation data is likely to be high. We expect it to print 0.9 to 1% for the quarter or more. And what the RBA does then, God only knows. But, Governor Bullock in her press conference last week was really interesting because she was asked about the budget and she came out and said, the Treasurer's told me it's going to be an inflation fighting budget. He's got a lot on his hands, but basically, she said, I trust him. I think it's going to be an inflation fighting budget. And yet, if you read CBA, HSBC, Barrenjoey, pretty much all the economists are saying the same thing, which is this is unambiguously stimulatory and it will unambiguously, therefore, increase or decrease inflation. Yes, you get the statistical anomaly of the power subsidies reducing inflation this year, but that's offset by exactly the same increase next year. Net, it's going to be inflationary.
Yeah. And like you say, I think if we piece all of that together, I think what we're going to take from this is that, again, maybe rates need to be higher here in Australia, higher for longer in the US. This sort of move in inflation is going to take longer than sort of central banks, are thinking, and it is going to be sort of a tricky sort of 6 to 12 months. So with all of that being said, as somebody running a $10 billion fund and maybe some advice to those investors, how do we manage this next 6 to 12 months? And if we're going to see higher inflation, if we may be going to see rates, higher for longer, rates may even go higher, we're clearly going to see central banks needing to sort of slow down growth. Unemployment is going to obviously need to sort of pick up to get there. How as an investor do you manage that, and where are there maybe attractive opportunities in your eyes?
First, I think you want to be really liquid, and you want to avoid illiquidity like the plague. So illiquidity, you find that in commercial property, venture capital, private equity, in private credit. High yield bonds are very illiquid. those asset classes will be the last to adjust to these interest rate shocks. You want to be in the asset class that's going to adjust quickest, and therefore the asset class that you can capitalize on. So I think cash is really attractive. You can obviously get TDs paying circa 5%. I think liquid bonds are really attractive. So, the major banks, we talked about the fact that bank equities are paying a tiny margin over bank bonds right now, but CBA bonds are paying 6 to 7%, right? So whereas CBA's equity, the fully franked dividend yield on CBA shares is closer to 5% right now. So CBA shares, which are levered 15 times, are paying fully franked 5.5%. CBA Tier 2 bonds are paying over 6%. So I think you want to be in liquid assets that are defensive, that are likely to have lower volatility, more capital stability. So I like high-grade bank bonds. And there are, we run funds that invest in those, but there are also ETFs offered by beta shares that supply access to those solutions. I like being immunized or insulated from cyclically sensitive sectors, as I mentioned. So in equities land, I think, you want to be in value. I just got to be obviously clear that this is not personal financial advice. This is just general information. These might, private views, but I do like the idea of value over growth. It's hard to imagine that growth will be strong in a world where interest rates are high and there are risks that have to rise further, and where central banks have not come remotely close to, generating the excess capacity and therefore the growth headwinds that they need in order to assuage these inflation pressures. And then I think you'll get opportunities as markets correct. I actually feel like there's similarities right now to what we saw in late 21, where there are big mispricings in asset classes. It is possible that we're wrong and inflation mean reverts fast, but even in that scenario, what's interesting, if we put ourselves in that position, let's imagine that everything I've said is totally wrong, and US inflation zooms back to 2%. If it goes back to 2% seamlessly and quickly as the Fed had hoped this year, or say 2.5%, I think was their forecast. But if it goes back quickly towards 2%, that implies if you take 2% inflation with the US unemployment rate being around 4% and US growth actually running above trend, that actually implies the interest rates are around the right setting. So the central banks of the world have a conception known as a neutral interest rate. And that neutral interest rate gives you 2% inflation, trend growth, and full employment. So we have full employment, we've got trend plus growth, and we've got inflation above target. But if I'm wrong and it isn't persistently problematic, it isn't sticky, stubborn, recalcitrant, then we will then be faced with another dilemma, which is, and this is called the neutral rate debate, but basically interest rates don't need to be cut very far at all in order to normalize them. And that's also a problem, I think, for risk and asset pricing more generally. And it's sobering to recall that the Fed's only delivered one soft landing since World War II, and that was in 1995, when they only cut interest rates by 75 basis points. So our modeling also implies that when we do see rate cuts, they're going to be much shallower than markets expect.
Yeah, Chris, I think it's some great alpha there for sort of investors to keep an eye on. I think especially when we look at markets and what we've maybe been expecting this year from maybe what we see in the media in terms of 5 to 6 rate cuts and that inflation is moving in the right direction. It's great to sort of get the other side of that picture and maybe what we could expect if inflation does stall and maybe we see rates stay at this sort of level and, as you say, a neutral basis for a longer period of time. Chris, as I say, thank you so much for joining us today. It's been a pleasure having you on.
Thank you for having me on, and appreciate the support from eToro.
Guys, make sure you stay tuned into Conversation with Leaders to get the latest from all the experts. Click the subscribe button and don't miss a beat. Thanks for watching, and see you next time.